I have met many of you before. It's obviously the first time I'm doing this at a distance, so I hope the technology works. So just diving straight in, Impax Asset Management is a business that I founded in 1998. I remain the largest individual shareholder, just over 7% of the shares. We've just reported on our financial year to the end of September. So we had a very good year. We grew our assets under management by 34% to just over £20 billion. We had record inflows. We've had a very resilient process and performance during the COVID-19 crisis, and a very solid platform for expansion. Just a quick summary of the financials here. So on the left, you can see that we grew 18% revenue, or revenue growth is 18%. We had a 29% increase in operating profit. And on the right, you can see the nice increase in assets under management continued into the first 2 months of our new financial year. So that's October and November, where we had really knockout inflows, £1.9 billion of new money coming in over 2 months. And that, with market movement, took us up to just over £23.4 billion by the end of November. And the bottom right, you can see the proposed dividend per share would represent a 56% increase on the prior year. Just a quick overview for those of you that don't know us. We're an investment manager focused on a particular investment philosophy. So we believe very strongly that the transition to what we call a more sustainable economy has with it some fantastic growth opportunities. And there's many really interesting companies that are often misunderstood by the market and give us an opportunity to buy shares, private or public companies, to buy shares and hold them over usually 5, possibly 10 years with a objective of beating the market. So many of the funds we run are in what we call our environmental markets range. That's a group of thematic strategies, for example, a water fund, a food fund, an environmental small cap fund. But we also have some more generic strategies in equities. We have some fixed income, and we also have some real assets. I think we do stand out globally as one of the largest investment managers in this area, so dedicated to exploring opportunities around sustainable development. Because we've been around for more than 20 years, we also have one of the longest track records. I think it's fair to say that in investment management, there's a polarization underway. So there's a lot of money moving to low-cost passive funds, typically equity funds. BlackRock, Vanguard, for example, being major providers. But then also there's another branch, which is boutiques. Boutiques have a differentiated investment idea, and Impax fits very nicely into that second category. So a focused manager known for a very clear, differentiated view of the market, and that's selling well at the moment for reasons that I'll explore. This is our history in a nutshell, measured by assets under management at the end of each of our financial years. So you can see that we were highly unprofitable for a number of years, very small, and really only got to profitability in 2005. We've had quite an interesting history, being through, of course, 2 if not 3 financial crises, and been growing very strongly since 2015. Really, I think as the last lag of the equity bull market run kicked in, and also the Paris Climate Agreement really puts climate change and environmental markets on the radar screen where they remain, and I think they are set to be significant, if not dominant, parts of the economic story for the next decade and beyond.
Yes, I was just about to go on to say that we are investment management specialists, and what that means is that we rely on quite an intricate network of distribution arrangements. So we have our own sales teams in the UK and the United States, and we have distribution partners, for example, BNP Paribas Asset Management, who work for us in several other parts of the world, continental Europe, and a good part of the Asia Pacific region. That means that we can really dedicate our time and expertise to managing the money and not rely on having to build up a big sales force to reach clients, given that the demand for our services really is global and 85% of our business is overseas. Many companies have reported on their COVID-19 experience. We've been very fortunate in being in a business area that's not been impacted significantly by COVID-19. We have been able to move assets around into companies that are well placed to benefit from the environmental testing, the healthcare related investment opportunities, and away from anything to do with energy consumption or transportation or leisure and hospitality. So generally speaking, a very resilient performance. This is a very busy slide, but essentially it says that our investment performance in the last 12 months has continued a strong run for the last 5 years and actually longer. So we've had very good numbers coming out of our investment funds and accounts. And what that means is that current clients have had a very good experience with us, are minded to stay with us and put more money in. And the story to prospective new clients is also very strong. The breakdown of our business can be shown in a number of ways. So if you look at the top left of this slide, this is basically our assets under management broken down by the different products. So specialists is the name we give to our small cap product, which invests globally. We have a all cap or mid and large cap oriented product called leaders. They're both environmental markets strategies. And you can see that we've got a nicely diversified product range. Equally by client type, so BNP Paribas is our largest distributor with 40% of our assets under management and about 31% of our revenue. But we also have growing business in the US through other channels on our own direct sales force. We have our own mutual funds and investment trust. And our business on the top right, you can see, is slight majority in continental Europe. That's continental European based clients. But the UK is now significant and growing rapidly, and North America is doing well as well. About just under 3 years ago, we bought a business in New Hampshire, United States, called Pax World Management, small investment boutique, which at the time was about 40% of our size. We have completed the integration of that business without any client or staff loss, and we're just about to complete the transaction by buying the remaining 17% or 16.7% of that business from management on an agreed consideration basis. So that will transact early in January. There's a possibility of a small amount of consideration, or contingent consideration rather, earn out if you like, which is payable if the assets under management in that unit exceed £6.25 billion by the end of this month, compared to £6 billion at the start of this month. So sort of in the balance as to whether they get there or not. If they do get there, it'll be a few $100,000 we expect to pay out. One of the things that we do for our institutional clients beyond investment management is report on environmental impact. We also report on the stewardship work we do with the companies we invest in, our so-called engagement. We do some policy advocacy, so we have 3 people around the globe who are working with regulators to help shape market opportunities for sustainable development. And we're also doing some research with leading academic institutions on areas like physical climate risk and water scarcity and water markets. Our financials are explained in a lot more detail in our earnings results and full deck, which is available on our website. That's impaxam.com. If you go to investor relations there, you can see the full deck. This is one slide, which on the right you can see the dividend payments, a proposed dividend of 6.8 pence for the final, on top of the 1.8 pence of interim dividend that we've already paid. As I said earlier, this represents a 56% increase year on year. It's also the first year that we have paid out under our recent or newly announced policy, which is to pay out between 55 and 80% of distributable profits. So we're at the lower end, but not the bottom of that range with this payment, but still able to significantly increase on the previous year. So just wrapping up, and I did want to leave time for questions, which normally are much more interesting to you, given that these slides have been available to all our shareholders now for just over a week. I think Impax is really well placed in the investment management landscape for the next decade and beyond. As I said, boutiques are really finding their stride now, with certainly those with differentiated and well-positioned investment ideas. There are very few investment management boutiques globally that have been working in this area of sustainable development for the length of time that we have. We have one of the world's largest, most experienced teams. Our investment team, or our management team rather, including the investment staff, owns over 20% of the business, and we have very, very low staff turnover. The products that we have are varied, but also have quite a lot of capacity headroom, which means that they can take a lot of additional client money without running out of space, without running into liquidity constraints. And over the last decade, in particular, we've developed a variegated distribution structure, which means that we have very little single point failure or dependency on individual clients. The business is really very well diversified. All that means is that we are really able to grow operating margin. We've got run rate operating margin at the moment of just over 30%, and would aspire to get that into the mid 30% level over the next 3 to 4 years, subject obviously to market conditions being reasonably stable. And the final point about the outlook is that I think with equity market sentiment being reasonably buoyant for 2021, we do have 3 particularly favourable additional drivers. There's the arrival of Joe Biden as president, and he has got very strongly articulated, supported policies around environmental improvement and climate change to follow through on. There is a new 5-year plan in China, which will significantly extend their commitment to sustainable development, spending on electric vehicles, on energy efficiency, on water supplies and sewerage systems, on sustainable food, and on related areas in healthcare. And the third additional driver is the COP26 conference, the climate change conference, which will be held in Glasgow in November next year, which will certainly bring climate change into the press, probably on a weekly, if not a daily basis between now and then. So plenty to look forward to in 2021. I'm going to stop there because I would definitely like to leave as much time as possible for questions.
So again, apologies if the subject matter jumps around a little bit from different topics. But starting off, why did BNP sell a large amount of shares? And for the second part of this, you can't answer. Do they regret selling at 510p?
The history with BNP Paribas is that they hired us back in 2006 to run a fund that they just established in the environmental sector. And in 2007, they bought 25% of our business on the secondary market, of our shares on the secondary market, and at the same time signed a memorandum of understanding to put in place a distribution partnership, which has been going for 13 years. So the reason that they sold shares really was to crystallize their capital gain. So they bought shares at 35 pence, and as you say, they sold them at just over £5. At the same time, they have cemented a long-term, now legally binding distribution agreement, which really puts a lot more substance under the relationship and reconfirms their commitment to the firm. So the sale was really just to realise some profits. They remain our largest shareholder at 14%. Do they regret it? Well, they've made an enormous capital gain, and I'm sure they're delighted that the share price of the shares that they continue to hold has continued to rise.
The share price has jumped spectacularly since the start of the month. Beyond what you've spoken about, is there any particular reason for this that you can comment on?
I can't really comment on the rise, but I can sort of reconfirm that we've had a very, very good start to the year. So you may remember that we've grown from 20.2 to 23.4 billion pounds under management. So that 3.2 billion pound leap includes 1.9 billion pounds of new money, so just over 900 million pounds in a month each, 2 successive months. Now, going back 12, 15 months ago, we were producing 200 to 300 million pounds of net new money a month, so that's quite an extraordinary jump. Our pipeline is still very healthy. December does tend to be a quieter month. January can go either way, so it's unlikely that December and January will be the same sort of level of growth, but we do have a very exciting future ahead, we think.
Next is a question about acquisitions. If you were to acquire any businesses further, what would you be looking for? What's missing in the product range, if anything, or what could an acquisition add to the business?
Well, I think the starting point is that we are not an acquisitive firm, and we do believe that organic growth is the bedrock of the business plan and can see us potentially even doubling the scale of today's business with that. So we don't need acquisitions to grow. We bought Pax World Management because we were looking for an acceleration of our US strategy, and they had been a distribution partner for us, and it just so happened that they were put up for sale by their family owners. So that was sort of serendipitous. Having said that, if you look at our product range today, we are very strong in listed equities, but we are at scale, but but not really a properly critical mass in two areas, fixed income and private equity. So if the right tuck-in acquisition appeared in either of those two areas, then we'd certainly take a serious look at it.
And next, I guess, is the other side about being acquired yourself. I think Aberdeen and Lion Trust came in to pick up some of that BNP disposal. Both of those firms have acquired recently. I think Lion Trust with Architas recently, and then Aberdeen today announced taking a significant percentage of Tritax, the big box firm. I guess what I'm trying to get to is there a pressure? Do you feel a corporate pressure that are the big boys circling? Have there been, I guess, do you see in 5 years' time that the firm being independent and carrying on as a boutique, or do you think it's more likely or taken out or integrated into a bigger firm?
Yes, I think it's important just to clear up a basic but important misunderstanding here. So there are three fund management groups who appear on a register, but those three fund management groups are not the management companies, but the funds run by those management companies. Aberdeen Standard has a fund which owns our shares. Lion Trust has a fund which owns our shares, and the other one is BlackRock. BlackRock, as run by Larry Fink, does not own shares in Impax Asset Management, but one of the BlackRock smaller companies funds, in fact possibly two of them, have those shares. So these are not shareholdings held by other fund managers. And that's actually, it's important just to sort of look at our shareholder register. So BNP Paribas owns 14%, management owns 22%, and the rest is effectively owned by a combination of small cap managers, most of which are UK domiciled. So I've mentioned three, but there are others as well, and then of course individuals and smaller institutions. So our shareholding is now quite widely spread. So the second part of the question about sort of where will we be in 5 years, I think it's important to reflect that success in investment management comes really from three things. It comes from having a great investment idea and philosophy, which can produce some great returns. It comes secondly from distribution, so sales, marketing, and access to clients, and then it comes from sort of execution and just getting the job done efficiently and in a compliant fashion. So many firms put themselves up for sale because usually one of the first two is missing. Either they don't have enough product, or the product's not good enough, or they don't have distribution. And I think what we've been able to do is to both create an attractive set of products and have a good track record of initiating and seeding new products, while at the same time using other groups to complement our own direct sales to build up this sort of nicely differentiated distribution arrangement. So this is a long-winded way of saying that we don't need to put ourselves up for sale anytime soon, if ever, because we've got those two bases covered. I think the other point is that in the context of markets which generally consolidate, asset management being no different, then big groups come along and acquire businesses like ours without management support at their peril, because this is a business which is entirely dependent on individuals, and therefore hostile M&A really is not a common feature. So unless that third element goes wrong, which is the execution fails, the business starts to demonstrate signs of sort of management weakness, then unwanted acquisition interest doesn't generally appear. So this is a very long-winded way of saying that we certainly don't expect ourselves to be up for sale anytime soon, if ever.
No, that's very useful. Thank you, and thank you for clarifying that. Next question, I'm going to read verbatim to make it clearer than my convoluted attempts at interpretation. It is commendable that the company focuses on sustainable development. How do you ensure compliance with ESG principles with your associate companies and their partners?
So I think the starting point there is just to sort of emphasize the fact that we are here to make money for our clients by investing in areas of the economy that we think are growing rapidly with interesting, often mispriced companies where we have expertise, and that expertise really is in those areas of the energy transition, transportation, food, water, materials, etc., which can be bucketed under the sort of overarching theme of sustainable development. When clients hire us, they typically sign up to one of our investment strategies, which typically have quite well-defined boundaries as to where the money will and will not be deployed. For example, the environmental market strategies are only invested in companies which fit into the FTSE Russell green revenues framework. So the sort of in-out definition that's generated by FTSE Russell is something we initiated ourselves back in 1999 before giving it to FTSE 2007. So first point to make is that we agree with our clients where the boundaries are. The second point is that for most of our strategies, there is measurable environmental impact, for example, around water use or materials recycling or renewable energy generation. And we've gone out of our way in the last 6 years to identify those environmental impacts by asking companies that we invest in for the data, and then producing environmental impact reporting, which we do on an annual basis, and that report is available on our website. So yeah, I think that probably covers the waterfront. There's the combination of mandate definition with very clear, relatively uncontentious boundaries for the space, coupled with the non-financial reporting.
Okay, and next one, the real assets business buys renewable assets that have zero residual value at the end of life. Is the dividend a return of capital as well as yield, and is it therefore overstated?
So several points in response to that. The first point is that the private equity strategy that actually buys assets in the renewable energy space is doing something quite different to the so-called yield cos that are well known in the UK market, like Greencoat or Trig. So what we're doing in that part of our business is backing the developers of wind and solar and hydro and other assets, and then putting the capital to get their assets built. But once the assets are built, we then sell them to sometimes yieldcos, but more often than not to utilities or institutional investors. So we're not holding the assets for the 20, 30, even 40 years of their life that a yieldco might. We're realizing a capital gain by developing, building, and then selling. So that question really applies to a yieldco rather than to us. Probably the additional clarifications are twofold. Firstly, that private equity business is now just a few percentage points of our total assets, so it's now very small. And secondly, the dividends that I referred to, so that 56% increase for year on year, those are dividends paid out of the profits that we earn from the management fees that we receive from the funds, of which the private equity component is less than 10%, and probably these days less than sort of 6 or 7%.
Okay, Ian, I think we're on time there. So thank you very much indeed for joining us this evening.
Great, thanks everybody.